Hi, this is Jay Hummel. Welcome to the Deep Dive Podcast in collaboration with Investopedia. We've had a number of common themes this year, but one of them has been about real estate. And I'm so excited to have a good friend of mine, Paul Barausky from Sealy, on the show today. Paul, welcome to the show.
Thanks, Jay. It's a pleasure to be here with you.
Man, it's awesome. And just tell the viewers a little bit about you and what you guys are trying to do at Sealy.
You betcha. Down at Sealy, based in Dallas, Texas, where I am, we are a 78-year-old company, really founded in the 1940s after the war, privately held by members of the third and members of the fourth generation. And we are experts and laser focused in the industrial real estate, what some people would call the warehouse distribution space. About 5 years ago, my longtime business partner, Peter Jackson, and I started Sealy Investment Securities, which is our capital markets group. So we're responsible for helping with the formation of our investment programs and then the raising and retaining of those assets. So we serve about 120 different financial, let's call them entities, whether it be, independent broker dealers, wealth managers, or as you know, I'm very passionate like you about the registered investment advisor space and the multifamily office space. So we started that in 2019. And it's been a heck of a ride over the last, now it's a little over 5 years.
Well, you could choose a lot of different verticals, right? And as I mentioned on this show, we had Jay Miller from Forum a few weeks ago talking about multifamily, right? And we're getting a lot of questions about different verticals within real estate. Why did you at Sealy choose where they are, and how do you see the marketplace today?
That's probably the best question anyone ever asks me is how did Sealy wind up in the warehouse space?
Oh,
Because let's face it,
yeah.
I've never heard one rich guy call his rich buddy and say, want to come see the warehouse
I
I
want
just
I want
bought.
to I want to buy a parking lot, a roof,
And
and
four
walls.
walls,
I mean,
a truck court that truckers are going to hit things all the time
yeah.
in. But it was interesting. The Sealy family started, as I mentioned, after the war in Shreveport. Interesting bit of American trivia to probably nobody but me. Shreveport was bigger than Dallas in the 40s after the war. Navigable, Red River, cotton, cattle, energy, etc. So they were really a general real estate firm, construction, brokerage. You had a lot of GIs coming back who needed things. And so there was a number of wealthy families in the area. I affectionately call the Shreveport Mafia just as kind of a joke, no relation to crime by any means, but they were pooling their investment money. And then it became apparent that Shreveport wasn't really growing, but other southern cities were. Think Atlanta, Houston, Dallas, Memphis, etc. And so Sealy decided to branch out with capital in those other markets. And when you're going to go to other places, I think a good rule of thumb for any business person is don't try to be a master. What is it? A jack of all trades and a master of none. So Sealy looked for one specific vertical or sector to focus on. And the decision was made to focus on warehouse distribution centers. And what's interesting to me is the same 3 or 4 reasons still exist today. And that's, stable occupancy, utilitarian buildings, low capital costs or tenant improvement costs. And that all leads to a little bit more predictable net operating income and hopefully some slow and steady growth. So I always say, warehouses really didn't get to be exciting and in everyone's purview till COVID, when even my 80-year-old mother started buying groceries online through Instacart, although she sends all the produce back, or at least half of it. So you look at those, that's how Sealy got in the warehouse distribution space, and that's why they're still there today.
So how do you think about it today? Obviously, as I live in Kansas, so I'm in an area where there's a lot of land.
Oh, yeah.
I can't drive anywhere where there isn't a lot of warehouses being built. One of the questions I get all the time is it oversaturated, right? And how does Silly think about that?
Well, I think I get that question every day. And so I just mentioned COVID, and it kind of poured gasoline on this excitement for warehouses. I would just say e-commerce kind of came into everybody's view even greater. I
Yeah.
saw a statistic that somewhere in like 21, we passed the US Department of Commerce's expectations for e-commerce growth. Like we passed the 2025 numbers 4 years early. I think you saw Walmart blow out earnings last quarter, and they had a 4.2% increase in e-commerce sales. So I think that if I'm a layperson or an investment professional, I know that things are heating up in the warehouse space. And so capital kind of ran into that space in a herd mentality. And let's face it, Jay, a lot of it was refugees from the office space who
Yeah.
said people are never going back to work. They're going to work in their basements, their dens, their Montana house, their beach house. And so where do we put this capital? Oh, look, everybody's buying things online and people need to get things. Remember, when the supply chain broke in the beginning of COVID, there was all that attention on supply, distribution, et cetera.
Right.
You had this herd mentality, and you are exactly right. A lot of new construction occurred because remember, capital was cheap. It wasn't that long ago. We were in a ZIRP or zero interest rate environment. So yes, I would say there are certain markets, to your point, where a lot of new construction went up and some of it hasn't been absorbed. And a lot of times, if you're an expert in this space, you can even get to submarkets and go, this one's good. This one's going to need a little time to kind of catch up. So we have seen that in certain markets, and we're just kind of fortunate that that's really never been where we play. What you're talking about going up along I-35 or Interstate 80 are these big 750,000 to 1.2 million big bombers, big boxes, single tenant, whether it's leased to Walmart or Dick's or Petco. I think we bought 3 of those in our entire existence of 78 years. So yes, in some markets, there's a little bit oversupply. But keep in mind, you can't really build anything right now. There's no capital. So absorption will catch up. And then what we like at Sealy is what you would probably call last mile delivery or infill locations. You're really hard pressed to see an oversupply of those because let's face it, I've been to your house in your neighborhood. I know that you probably take back roads to your office or to your kid's soccer field. You pass those infill or last mile delivery, 100,000, 200,000, 300,000 warehouses. But let me ask you a question. When your lovely wife, who I've met, your much better half, wants to take the kids somewhere or wants to get the kids a new baseball glove, she wants it when? 2 p.m. that afternoon?
That's exactly right.
Does
Yep.
she want a new warehouse outside of your neighborhood, though, with trucks and vans driving around?
No.
No. So nobody wants the new ones, but they all want their stuff. That's why we think that supply-demand imbalance continues to work in our favor as a landlord. And so that's kind of my answer to that oversupply. It's market by market, it's asset type, it's location, and then it's the tenant inside of it.
Well, and obviously, most of the people who are watching this show are home office or advisors. How do you think about investing in your vertical from a vehicle standpoint? Is it a perpetual fund? Is it a GP LP? How do advisors help their clients invest to take advantage of what you're talking about?
So first, I would be remiss, and I'll make our compliance director very happy, and that I'm always, as you know, hesitant because we're filed as a 506B Reg D with no public solicitation. But since your show is aimed at wealth managers, financial advisors, and key home office folks, what I'll say is a simple yes. I'm a huge believer in an allocation to industrial real estate as a core piece of a portfolio. You and I have talked about the importance of alternatives in a growing portfolio. You were one of the people I consulted for how does somebody scale their practice, scale their enterprise value? And the answer is more high net worth and ultra high net worth clients. And we know through research that the fastest growing practices are adding significant piece of alternatives to those portfolios. Within that, you need core positions. Industrial is proven to be a bellwether position. So look, if somebody wants to go out and buy it, let's go a different route. Fully liquid and traded. They could go buy Prologis, First Industrial, Stag, and have almost 70% of the market cap for industrial. But now you're subject to the vagaries of the market and the correlation with everything else that goes with it. So on the other hand, to answer your question more succinctly, you could look at a finite life private placement, maybe a finite life REIT, look at a 5 to 7 year holding period on something and look for the returns you want with, I'd say a more static position that might be valued once a year, once a quarter, et cetera. And that's what we've done for our investors and advisors really for the last 12 years when we moved out of large JVs with folks like CalSTRS. We are moving towards a perpetual vehicle also as a companion. And it's simply that we recognize that, different chassis, I guess, can operate slightly different engines from the same manufacturer. So a perpetual, somebody might say, look, I might need a little more liquidity. I may want it quarterly. Or I work with somebody who just demands monthly valuations. Once a year is not enough. So my answer is all of them. Just get into industrial as a bellwether position. And I do believe, though, that you get the most alpha or return from that far left side that I talked about, which is finite life, private, limited liquidity, and let it cook.
No, I don't disagree with that at all. And our last question, Paul, is, as you know, because you've been on the show before, I always ask every guest, it could be in your swim lane or it could be in the wealth management space. What's the one thing that you think people aren't paying enough attention to?
When you shot me over a couple of things we might talk about, I specifically decided not to talk about real estate. And I pondered your question, and I think it's the coming succession crisis in our business. I look around the room and, at my mid 50s, I should be one of the older guys in the room. And usually I'm not. Usually I'm around the middle. So you and I have discussed this previously, but not in depth. But advisors are aging out. If you look at the demographics of our industry, there's some real jeopardy out there for both clients and firms if they don't firmly think about succession. So there just isn't enough grooming of that next generation or training, I believe, that's going out there in a meaningful way. And I think for firms that creates incredible client retention risk. It's a real risk to their ongoing valuations. And there's some real legacy concerns. And I just feel like as an industry, we're still dancing around the periphery of it, and not enough folks have really dug into not only what it means, but how do we work on it, whether it's as an individual firm, an individual advisor, or an overall industry. So that's really something that I've been thinking about lately, and I would guess you have too.
Well, yeah, as you know, I wrote a book on it in 2016. I was early. I was really early on that. But no, it worries me, and I just think across not only with the wealth advisors, but what you guys do, right? I mean, Sealy does great things for advisors and for their end clients. It's just we're gonna have to figure this whole thing out. So
yeah, I mean, you hit it on the head, right? We have a chairman in his 70s who's really thinking about his legacy. He has 2 sons in their 40s. But it's important for everybody in business. And as our business has matured, we've simply gotten older.
But I did laugh with somebody this morning. I said, succession only becomes a problem because you've been successful. No, nobody worries about succession when a business fails. So there's a lot of people who are going to watch this episode and hear me pontificate about succession. And the reason they have a succession issue is because they've been successful. So there's a lot worse problems than
I agree with that 100%.
Than everybody has. So, well, Paul, obviously you're one of my best friends. I can't thank you enough for coming on the show, and hope you come on again.
It's a pleasure to be here. Thanks again.
Well, guys, everyone, we're going to continue on the theme of real estate. We're going to continue on the theme of ultra high net worth service going forward. Thank you for watching. We'll see you next time on the Deep Dive.